Hi, everybody, and welcome to another episode of the Outmarket.pro podcast. I'm your host, Mark Stein. In this episode, we're going to take a deep dive into the insurance industry with my guest, Michael Smith. He's president of TFP Brokerage, based out of the Atlanta metro area in Georgia. TFP Brokerage is an insurance brokerage general agency that offers life, disability, annuity, and long-term care products. He has a very interesting tool that he recommends and uses for most of his clients that's an investment vehicle and also has many other benefits. So we're going to dive into that today. So welcome to the Outmarket.pro podcast, Michael.
Thanks, Mark.
So if it's okay, I'll call you Mike.
Sure, absolutely.
All right, make it a little friendlier.
The only people who call me, people who used to call me Michael was my mom when she was mad at me.
Right. And my brother says, I don't care what you call me as long as you call me to dinner.
There you go. And
all right. So why don't you let's start with your background and how you got to this spot with your agency.
So I started in the industry, in the life insurance industry in 1983, straight out of college. I got into management within a couple of years with MetLife and ran a branch office there. And we were very successful recruiting a lot of people. So we built a really nice office in Roanoke, Virginia, which is where I'm from. Then I went out on my own. I didn't want to be a corporate employee any longer, so I went out on my own with the group for about 5 years, and then John Hancock recruited me in 1993 to become their general agent there in Roanoke, and we grew that from just the Roanoke area to Richmond, Raleigh, Harrisonburg, Lynchburg. And eventually we took over the Atlanta agency, and I moved my management team down there. Then in 2008, we started the Financial Partners group, which we trade today as TFP Brokerage, and that's a DBA. And then in 2011, went totally independent. So that's my background. I've been independent ever since.
Got it. And let's give an overview of the products, and then let's focus on this one that's really intriguing, that is your main bread and butter, as I understand it.
Yeah, so you outlined the products in your intro that we deal with on a daily basis. But in 2011 or so, we ran into a very interesting situation in Atlanta with a family office that was looking for some advice on their life insurance, and they had a set of the family office attorney had a set of criteria he was looking to lay out and get advice on, and so when they chose 3 firms to interview, and when it was our turn, when he laid out the problem, I told him that I couldn't see any other way to solve it but use premium finance life insurance. And so that's the answer he was looking for. He chose us, and it was quite a project. It took us about a year to implement the entire plan. And premium finance life insurance is really exactly what it sounds like. It's no different than people have been using leverage for, borrowing money since the 1700s. In this case, you're borrowing money from a commercial bank to fund a life insurance policy. You're just doing it in a very unique way that most people don't even know exists.
Okay, let's dig in. Keep going.
Okay, so what we do is I'll get a set of, so I work with financial advisors and insurance brokers, and they'll come across a client. Like I had a client, a broker come to me today. He has a potential client that is looking to purchase quite a bit of life insurance, but he doesn't want to The people that engage in premium finance life insurance don't want to pay premiums the rest of their lives. That's the typical structure of a life insurance policy. You buy it, you have a premium, and you pay it until you die, right? With a lot of people that find that unattractive. And a lot of times they won't do it for that very reason. So with premium finance life insurance, we have several structures that we offer people. But in a death benefit only structure, we usually will show an out of pocket for 5 or 10 years on behalf of the client. And almost always it's considerably less than what they would need to pay for just buying a policy outright. And then they borrow the balance, okay, to fund the policy. And we're using index universal life policies where we're expecting there to be arbitrage with on the returns of the indexes in the index policy as compared to the bank loan rate. So the arbitrage is really the key. And there's really two forms of arbitrage here. One is the one I just described, and the other is the premium savings over time that you can use to reinvest in your business or your other investments or whatever. So there's really two significant benefits to using premium finance.
And can the business take out this policy, or does the individual, or can either?
Either. And when a business takes it out, a lot of times, now I'm not giving tax advice here, but a lot of times the controller or the CPA who advises them on their taxes will allow for a tax deduction for the interest.
Okay.
So it can create some significant tax deductions for the business.
Okay. And what are the benefits of purchasing it by the business as opposed to the individual, and when would either kick in? And you know what, let's give a blanket disclaimer. Please do not treat any of this as legal advice. And he's an expert in his field, and this is a very narrow field. So we're happy to have the benefit of Mike's advice, or information, but please don't treat it as legal or other financial advice. We'll give his contact information at the end.
Yeah. So that's a very complicated question that you asked me. When's it better for the business as opposed to an individual? It's really a risk. It's really a needs assessment that's done with the client to determine what they really are trying, what's the most important aspects of what they're doing, because there's different tax benefits and tax disadvantages for one based on the other. For an individual to buy it, you're not going to deduct the interest in that situation. If you just buy it outright, or you have a trust out buy it, or you shouldn't. Not giving tax advice again, but in a business you might. And we have like, for example, we have a CPA that has an insurance license that writes a lot of this stuff on her clients, and she has them all buying within their business, and she deducts the interest. And that's one of the main things that's attractive to them. Not only do they get the insurance, they will be eligible for downstream income, which should be tax free if it's done properly. Which, if we're doing it, we will. And but you get the tax deduction. And so an individual, won't get that deduction, but may enjoy some of the same benefits.
Mm-hmm. So this is death payable upon death only. And who are typically the recipients or beneficiaries of these policies? The kids, the business? Give me some examples.
The kids, the business, a trust. Once again, it really just depends on what the individual's trying to accomplish. So, and it's not just death benefit only, Mark. That's one of the structures. There's
Okay.
also, we probably do more business and certainly more cases in a tax-free income strategy, where, as you know, or probably know, a lot of baby boomers and the next generation are behind in their retirement savings. And this is a way for them, a lot of people see this as a way for them to catch up pretty quickly.
Okay.
The IRRs on those tax-free income strategies are almost always showing a pre-tax IRR equivalent over 20%. So in other words, the individual would need to be able to generate 20% or more on their money before they have to pay taxes, in a mutual fund or whatever they might be purchasing. And that's over the lifetime of the insured. And that's pretty, as you know, that's pretty hard to generate.
Mm-hmm. How does this fit into a strategy involving a revocable trust? I'm less familiar with irrevocable trust, but talk about how all this melds into a comprehensive strategy.
So, premium finance started back in the 70s, and was for a very long time was only used by the ultra wealthy to buy large amounts of life insurance held in trust to pay estate taxes.
Okay.
And if you talk to people in the industry that have some knowledge about it, most of them, that's all they know regarding the use of premium finance life insurance. They're not familiar with the fact that it's also a very attractive tax-free income strategy for people as well. And the reason it's so attractive to people from an income standpoint is the money has already been taxed that goes into life insurance. It's not a qualified plan. Okay. So, the person's earned their money, they've got it set aside, set it in CDs or money market or, wherever they have it. And so the money that goes into these things has already been taxed. But so now the decision is, where do I put that money? Okay. And so you can put it into a premium finance structure, let it bake for a while, usually in excess of 10 years. Is ideal. 15 is really ideal. And then you start generating tax-free income from the structure for a period of time. And then when the person dies, there's a death benefit left over. That's payable to the beneficiary of the policy. And the whole thing's tax-free. The IRS never sees a dime from it.
Hmm.
That's what's really attractive to most people that engage in these, or at least show interest. Now, how's that fit in an estate plan? You mentioned irrevocable trust. It certainly could be owned by, a revocable trust. It could certainly be owned by a revocable trust and get all the benefits that we just talked about.
Mm-hmm.
Or it could be, but that would be a situation that would be estate taxable. Okay. Or it could be owned in a irrevocable trust. And if that's done properly, and the notices are done properly, at death, those insurance proceeds will be free of estate taxes.
Mm-hmm.
And that's what's the industry in general thinks of premium finance life insurance as a resource. That's how they think of it, as a resource.
Can you make this a little more concrete for us by walking us through maybe a representative client without using a real client, of course, but sort of walk us through it? And I know I didn't ask you to prepare this, but I think it might make it a little more concrete for some of our viewers, if you can. And, I can even, if you want the use of the screen, I can share the screen. And again, I know I'm catching a cold on this, but you may have something that's a prototypical situation that you might use here to show, or you may just want to talk us through a scenario so that people can really wrap their heads and arms around it.
Yeah, so I've got a couple of models up here, and it's hard to put these models up and go through quickly. So I think I'd rather not do that.
Okay.
I might just complicate the whole thing if I do that. But here's a scenario. This was a developer We have not written this case. He's 44 years old. He makes considerable amount of money, but he's looking for tax-free income at retirement. Okay, so we proposed a $6.3 million face amount policy, have him pay $100,000 out of pocket for 5 years. Okay, start generating income at retirement. His retirement target is age 65. We're showing $700,000 of income to him, tax-free income to him through age 89. So that's, $17,500,000 of income tax-free for $500,000 investment. And if he lives to 89, or if he dies at 89, his family will get almost $15 million. Okay, so for $500,000, he's going to get, his family could. Of course, all these numbers are subject to change because we're doing long-term projections. So, these numbers will change. Hopefully they'll be better, but they will definitely change. So for, $500,000, he and his family might get as much as $32 million out of the structure.
Wow.
Yeah. The pre-tax IRR, and that's over 21%. So that's the power of these things. I have another one that this is a death benefit only. These are developers out in the Midwest, husband and wife. They were looking at a $20 million second to die policy. They were going to pay somewhere, I don't remember the exact numbers, somewhere around $150,000 a year. And that was going to be payable for life. And they were going to set that up in a trust and have that for estate taxes. Okay. So the broker came to me and said, do you have something that would be similar or better? So what we recommended was a $10 million individual policy on each of them, the same $150,000 out of pocket, but just for 10 years. Okay, and I only have her model here in front of me, but if she lives to be 85 years old, the projected death benefit of the policy is going to be over $30 million. So instead of having a finite $20 million that they pay $150,000 for life, I would say his model probably grows to about 20 million because he's male and older. They might, so they could pay the same 150 for 10 years maybe, and they might get as much as $50 million out of these two policies. Okay, so that's the power of leverage, and that's how people have been using leverage since, I mentioned earlier, since the 1700s. Buy real estate or a business or farm animals or whatever they've been buying it for to grow their wealth. Most self-made people have used leverage to build their wealth.
I can't think of any investment that has this kind of returns. Are you aware of anything? Guaranteed returns. I know there's some variables with age, how long you live and everything, but it seems incredible.
Well, and the first time I meet with a broker, normally not the client, because the brokers usually run interference with the client and said, you're going to see some pretty interesting numbers. They, before I meet with a client, with the broker or a financial advisor, I've spent a lot of time with that financial advisor or insurance broker and educating them on how all this works, showing them the risk factors, stress testing so they understand what those risk factors mean. And so, but almost always the first time I show this to a new advisor, the first thing they say is, this looks too good to be true. Okay. Which is exactly what I said the first time I saw it. And so, so I'm used to dealing with that, with that issue regularly. And, and my response to that is, well, the data from the carrier is what it is. I don't have any, ability to change that. All that's under compliance rules and their legal department, and what they produce is what they produce. And so I just pull the data over. Everything else is formula driven in the spreadsheet. So, I know it looks too good to be true. I thought the same thing when I saw it. And usually when something looks too good to be true, it is. In this
Right.
case, the thing to do is if you're interested enough in what the benefits are for participating, let's dig down deep and make sure you understand exactly how this works, and then you can decide whether it's too good to be true or not.
Right. And I can see how it's important for the financial advisor or broker to run interference, because you could, if you were talking early on with the client, you could trigger some fears, give them sticker shock, with how much they need to contribute per year. So working that out with a financial advisor seems to make a lot of sense,
Yeah.
because they'll know what their trigger points are, what their pain thresholds are, what their risk is, tolerance is. So I can see how it would really be beneficial to work this out so that the financial advisor not only understands it, but is on board and advocating for this technique, for this strategy.
Well, and the financial advisor should, and most cases does, really understand their client's, financial position.
Right.
So the risk of these things is collateral. I mean, the bottom line, you have to post collateral in these structures to keep the banks happy until the policy accumulates enough value to be more than the outstanding loan. And
Okay.
that's somewhere around 6, 7, 8 years. Something like this one I'm looking at is 8 years. So for the first 8 years in this death benefit only strategy that I mentioned, they're going to have to post collateral for those first 8 years. Okay. In this case, these people have no issue posting collateral. I mean, and in this case, they're heavy into real estate. They have quite a bit of commercial real estate that's free and clear of any kind of leverage. And so they can simply use one of those buildings that they have and get a line of credit against it, and then have that same bank issue a letter of credit to the bank that's lending the money for the financial, for the premium finance. And, they'll pay a little bit for that line of credit, but that's it. That'll be their pain point. So I recommend they set those lines of credit up as much as twice what the high point of the expected collateral is. So we really never even have to talk about it. They just go back to the bank every year and say, I need you to raise that line of credit from $140,000 to $250,000. And if it's a $5 million building, the bank will readily do that.
Mm-hmm. Does the price of this, is the price of this insurance, like other types of life insurance, related to the age, health, of the clients, and or does it manifest through, not through premium, but through the amount of collateral?
Well, so the answer to your question is yes, it does. The pricing of this does depend upon the age and health and gender of the client. Okay. But this is different because there's this little known rule out in the life insurance world called the modified endowment contract rules. And these came into being in the late 80s, when the IRS stepped in and said, these life insurance policies are not being used for are taking advantage of the tax rules. So they put a cap on how much money you can put in these life insurance policies. Okay, so we're putting way more money into these policies than you would normally expect to put into them. Like in this case right here, this lady, I told you it's a husband and wife. This lady is expected to spend $67,000 a year for 10 years out of pocket, but the premium is $660,000. Okay, so she's borrowing the difference, and the reason that's so important is once you've covered the main cost of the life insurance policy, there's very little cost in these policies. And yet it's all growing tax deferred. Money comes out tax free. When you're using these index universal life policies without getting way down in the weeds, a huge advantage of them is that they have their market-based returns that are based on S&P or low volatility funds managed by Putnams and Fidelities and Barclays of the world, but they have a zero on the downside. So in 2008, when the market crashed almost 40%, these things got zero. And these things actually gained because of the way we manage the money within the policies. Okay, so the key to that is that once you take one of those big hits in the market, you'll see the market come roaring back, right? And then you're eligible for some 10s, 15, and 20% returns. So, down volatility in your portfolio is not your friend. Volatility in this is totally your friend.
For those who use commercial real estate as a collateral, we've seen a tremendous decrease in the value of commercial real estate, especially office buildings. Have you seen where the value of and sometimes they'll sell for 20% of what the person bought it for in a fire sale? Does this require additional collateral to be provided on a periodic basis? Or is it like the sale of these buildings, the eventual sale of these buildings, that the actual value, current actual value does not kick in until it's actually sold? What's this volatile and underwater commercial situation currently? How does it affect those who put commercial buildings up for collateral?
Yeah. So if you're using a building for collateral in a structure like this, and you're at 20% of today of where you were when it was appraised, you're going to have to come up with some other collateral somewhere, probably. And that's the bottom line. And so, that I always recommend clients, especially when using real estate, to put a line on that real estate that's substantially more than we ever think we'll need. Okay, and that does two things for us. Number one is I don't have to keep going back to them and saying, "Shoot me another check for $100,000 or $200,000." Nobody likes that, even if it's for collateral, even if it's put in a certificate of deposit, even though it's their money, they're just setting their money aside. Nobody likes to do it.
Right.
We do it, and and sometimes we have to, but it's no fun for anybody. And these banks will release collateral as the policy grows in excess of loan too. So you'll likely get that collateral back and be able to use it any way you can. But you still have to, in those early years, you still have to, if you're putting the exact amount aside for collateral, you're going to have to put up more than the next year and the next year and the next year. That's just the way it works. Mm-hmm. Usually for about the first 5 or 6 years, your collateral is going to increase and then it'll start coming down. In the case of real estate, I suggest them to get a line of credit on their building that has very little cost to it, maybe no cost to it other than initially. And if they don't use it, they're not going to be paying interest, right? Mm-hmm. And so then they issue a line of credit against that. There will be a cost for that. It's pretty low cost as well, depending on what bank you're using. And they just reduce access to that line of credit. So in other words, if you have $1 million line of credit on a building and you need $100,000 letter of credit, they're not going to reduce your $1 million line of credit. They're just going to reduce the access to that line of credit from $1 million to $900,000. Okay.
So that they can get it if they need it.
That's right. So they can get that other 900 if they need it. That's right.
Okay.
So, and I know I've mentioned this before, but the risk of these structures is totally about collateral. As long as you keep these banks happy from a standpoint that they're always whole, they'll continue to participate.
Okay. Let's talk about let's set a floor in terms of annual earnings, net worth. Let's set a floor below which somebody should just forget about it. Yeah, I was intrigued about the 24-year-old who had such assets. Just out of curiosity, did they inherit this, or did they inherit a business like a construction company? I don't know many 24-year-olds that can have that kind of net worth.
Well, professional athletes.
Oh, okay.
Yeah. These things are beautiful for professional athletes because they're so young. The insurance costs are so minimal, we have proposals out there for some professional athletes to bridge from whenever they retire, whenever they're not playing sports until their retirement age, till their pension kicks in. That's a way that they use these. And we hope to use them, that we do more of that.
Yeah. And supposedly, my understanding is they're like lottery winners in that lots of them end up with nothing at the end of their career because they've spent it lavishly.
Yeah, well, we have a gentleman that works with us and he's worked with us for almost 5 years now as part of our team, who played in the NFL for 7 years. And so we actually set up a company and a website called Legacy 6. And that's what it's all about. It's educating athletes on how to manage their money, how to be responsible with their money. And that's a very complex subject, by the way. Because there's a lot of people coming at them from a lot of different directions once they sign these big contracts.
Right.
But the statistics are really sad about regarding the number of professional athletes that actually go bankrupt post their playing days. And you'd be surprised, without mentioning names, you'd be very surprised, probably, maybe you wouldn't, but most would, about how famous and how successful some of those people were, and how much money some of those people made as well.
Yeah.
They lost it all. So, so in terms of your question, though, about what's the minimum thresholds, at age 50 and under, it's $250,000 of income and $2.5 million of assets.
Say it again. 250
of income, $2.5 million of assets.
in any form, assets in any form.
Assets in any form. Yeah.
Okay.
And I say that, I mean, if it's all in a very speculative crypto, probably not. Right. And then over 50, it's $5 million and $250,000 of income. Now, there's exceptions to all that. If you have a younger person that's making substantially more income than that, but don't quite have the assets, we can get that. We can get that approved. And
what was that on over 50? 5 million a year, and what in assets?
5 million of net worth.
Okay.
And 250,000 of annual income.
Okay.
So I was saying, there's some exceptions, but there's also exceptions on the other side. The last thing you want to, we won't do it, but the last thing one wants to do is be skinny on their collateral, their liquid assets, and enter into something like this. I mean, you just don't want to do it that way because, when these things go wrong, they go pretty wrong, especially in the early years. Once you get out of ways, it's not the same thing because the policy will will have had a chance at that point to get the kind of returns that it needs to get well ahead of the loan. And so the risk is not the same. But in the early years, we're very careful about looking at the assets of an individual and counseling them on what they need to be doing to plan for the risk of this. And we haven't had one blow up yet. I mean, I know what's coming at some point in time. Life happens to people, but we've been very careful about engaging in these, and we continue to be, and we always will be. It would be really. I would love it if the day I go to the grave, we can say that none of these things ever blew up on us.
Mm-hmm.
That'd be really nice.
Yep. And pardon the cynical humor, but with the football players, the professional football players, you just want to get to them before they get knocked around in the head too often and too hard, so that they can't make complex decisions like this.
Well, we've got a team of advisors that are associated with Legacy 6 that are used to dealing with professional athletes and entertainers. And they have, a very strong, strong pedigree of working with folks like that, and they know how to counsel. And so doesn't mean that everybody will listen, but at least we can put them in a place where we know that these guys have been very successful long-term with, lots of different entertainers and athletes, and help them navigate this world that they're in. And, and it all boils down to a family financial philosophy. Okay. And it all boils down to that, and building that philosophy over a period of time is not easy to do. I mean, you bring family members into that conversation. Everybody's agreeing on what the plan is and, what's good and what isn't. And so then when their buddy approaches them for a restaurant, we go right back to the family philosophy and go, okay, where's that fit in here? This is what we all agreed to do originally. Now, where's that fit in here?
Mm-hmm. And, as I look at these thresholds, especially the annual income, there's a lot of professionals and business people that fall into that category. So it's probably more the total number of assets, value of the assets, that's the tripwire, I'm guessing.
Yeah, I mean, and it should be, it really should be. I mean, I mentioned earlier, you don't want to go into these things skinny, I mean, you just don't want to do that because, stuff happens. And, you want to go into it with a plan. You've got a collateral plan. We know what that plan is. My top advisors, they won't enter into one of these structures with their clients unless the client posts at least twice the collateral that we anticipate is going to be needed. And
Okay.
and once again, that just sets them up for success in this. And success is significant in a structure like this. And it also avoids the awkwardness of having to come up with money every year that nobody likes.
Right. No matter how much money they have, having to pony up more than they anticipated or had in their minds, even though you prepare them, is still, nobody likes it. Yep,
Nobody likes it. No, they don't. So we'd like to put it in all possible.
right. And you want referrals, and you're certainly not going to get a referral from somebody that's taken a bath on this.
Yeah.
Let's talk about some of the professions or business types of businesses that your clients cluster under. What are the most prominent types of businesses?
Let me just look here at our book of business and just give you some idea. Pharmacists that own their own business. A lot of them own their own business. Own their own real estate. This guy's a food manufacturer, a very rural area. Doctors, retired corporate people, ranchers. We do well with ranchers and farmers. They have very unique needs in terms of liquidity.
And a lot of them are just amazingly wealthy at a certain point in their career, near the end of their career.
They are. I mean, and what I've learned about this in dealing with them is they also because of all the investment and depreciation and everything else, they're tax averse, and they're able to keep their taxes low because of the investment and the credits and everything that they're getting. I mean, their tax returns are fascinating. Let's see, this guy here, retired.
And let me just ask you this. I would imagine that a lot of them, especially in this day and age, because to remain a farmer through today is no easy feat. So they are dealing, just a piece of equipment is incredibly expensive.
Yes.
So they probably have a level of sophistication, financial sophistication, that some of the other business people might not. I think we assume that ranchers and farmers are, hillbillies and not very smart. But in order to be successful late in life and at this point in time in agriculture or farming of any sort, they have to be either financially smart or have really good financial advice.
Or both. And everyone I've come across has very astute advisors associated with them. And you're right, they're really good business people. I'm constantly amazed, and we have a bunch of them that are clients. Let's see, doctors, dentists are good clients. Someone that just sold their business. We have a number of clients they're looking for. I have an advisor down in Texas. He calls it a warehouse to put money, tax-free funds. So he sets these things up, and then as these people come into money, this is a place they can put it, and never pay taxes on it again.
Mm-hmm.
That's very attractive to a lot of these folks. Real estate investors, attorneys. We have a number of attorneys. A couple of surgeons, another pharmacist. Just general. We have a CPA that is Latino, and she focuses on Latino business owners in her market. And these are guys that own grocery stores and welding companies and are plumbers and home service people that have started with a truck and a wrench, and have grown it to out of their garage, and have grown it to tens, maybe hundreds of employees over the years, and have become very, very successful people.
Mm-hmm.
And they've got their own unique issues to deal with. So
let me hit you with a tangent, but related. We're about to go through the most significant change in employment that we've ever seen, certainly, and probably I'm talking AI here, that the world has ever seen. And it's going to hit knowledge workers and the people on your list that you just listed a lot sooner than it's going to hit one category or a couple categories, the plumbers, although they will eventually be replaced with robots, but it's going to take probably 10 years for that. So if you've got people, and I'm asking, is an at-risk group, someone in the tech industry maybe their IT, their senior executives. Most of those are probably going to retire pretty soon. And I know one in particular that said, I've been through the internet, I've been through lots of different changes, and I do not want to be responsible for a big company's IT security in the latter stages of my life. But we're going to start seeing some people and some younger people, like on the West Coast and up in Seattle, with significant income, and some that have accumulated significant net worth that are just going to be out of work. And we're starting to see that already. Do you see that as a risk, additional risk factor? And are you, when you're looking at the financial future of some of these people, are you baking this change into those recommendations?
That's not, in most cases, that's not really my job. That's really the financial advisor's job, right? Because keep in mind, most of the business that I do, now we do some direct business with clients, but mostly, almost all referrals, actually. But, the financial advisor normally brings me the client.
Okay.
And if they're good, they're thinking through things like that. And most of the financial advisors that I do deal with are very good, because otherwise they, that have, teams and staff that, are very sophisticated and have a deep understanding of their clients and what their future looks like. So do I get into some of those conversations with clients? I certainly do. But it's usually put in front of me by the client and or the advisor.
Okay. So as we're starting to wind down here, is there anything that you would like to share that I haven't asked or you haven't thought to mention thus far?
Not really. I mean, I'm surprised. I'm constantly surprised when I meet a new advisor how little knowledge they have of this structure, that have high net worth clients. And so, what I would say to an advisor or a client is, if some of this sounds interesting to you, let us show you a couple of examples of how it can work for you, and talk you through the risks and and the volatility, because there is some risk and volatility in this. There isn't everything. And so, but see if you can figure out a way, see if you can find your way to participate in something like this, because the returns are outstanding. And you asked a question earlier that you didn't know of any other asset that would give these kind of returns with so little bit of risk relative to other things that are out there that are generating 20+%. And that's very true. And some of the advisors that I deal with, what they do is they shift money from some of their safe, every portfolio has some safe money. Usually it's some kind of bonds or income or fixed annuities or what have you, CDs. And what these guys do is they shift some of it, not all of it, but they'll shift some of that money over into a structure like this to create a tax. They all call it the same thing, a tax-free bucket. And so if someone has interest, an advisor or a professional, CPA or an attorney or banker or anybody else who might see this podcast has interest in this, you really owe it to, or a client. You really owe it to yourself to take a look at it and see if it's right for you.
That's a good segue into if people would like to discuss this with you, and there are probably not a lot of people around the country that are as deeply invested in this sort of mechanism as you are. How would they best reach out to you? Give us the website, email, phone if you want to, however you would like people to contact you.
Yeah, so our website is www.T as in Tom, F as in Frank, P as in Paul, brokerage.com. All of our contact stuff is on there. Phone numbers, email addresses, it's all right there. So it'd be a good way to learn about what we're doing, and and how we go about this. And our contact stuff is right there, so they could find us there. And my email is mike@tfpbrokerage.com as well.
Okay. And for an initial consultation, do you charge for your time?
No.
Okay. All right. Well, I learned a lot. My head is full of a lot of it as I'm sorting through it, but I'm getting it as well. So thank you for that, and I hope the audience does as well. And we'll reach out to you if they're interested in pursuing it. And let me ask you one other quick question. Have you thought about doing webinars, videos? I saw an introductory one on your site, but have you thought about doing a series of these that would break it down further and get that information out there?
So I've always been a numbers guy, to my detriment. A good relationship and numbers guy. But in terms of marketing, I mean, I don't get it, and I never did get it. So I just recently, within the last year, retained a very interesting. He's become a good friend of mine, a consultant, and we're talking about all kinds of things like that. I mean, if you went to our website, that website has been totally revised over probably 6 months ago. Okay, and this gentleman has been, like I said, a good friend and a good consultant to me, because he'll just simply tell me, your website stinks, Mike. You got to do something different than that, And so, we are talking about stuff like that, but we don't really have any concrete plans. But it's a good suggestion, and we definitely want to grow our business. And if we believe that the investment of time and energy and money into something like that will pay off for us, and we'll most likely do it.
Great. All right. Well, I want to thank Mike Smith for being with us and sharing more about these really interesting instruments and his industry in general. To learn more, please look for his contact information down in the description. We'll put all of those contact methods down there. If you want to learn more about outmarket.pro, just go to our website. We do have small business solutions of all types using technology and low-cost labor. So thanks everybody for tuning in. If you liked what you saw, please click the like button, subscribe, and click that notification bell. And we'll see you next time on the outmarket.pro podcast. Thanks everybody. Thanks again, Mike.
Thank you.